Welcome back to another video. In this video, I am going to talk about a famous study, Bessinbinder Study, where the paper established that only 4% of all companies on the market were able to actually outperform the return of a treasury bill. So 96% of companies on earth couldn't even beat a simple T-bill. And I've ran my own simulation using a different metric, and it's a far more punishing method. And this is what we have to do to establish a true return on investment. And this paper is famous for traditional retail finance to use this to tell people you cannot pick stocks. It's like choosing a needle in a haystack. And it's actually the opposite. Because if 4% of companies on earth generate all the returns, they're highly visible and very obvious. And what I've done is I've ran through every global stock market exchange to see what their true returns are. Now, instead of measuring it against a treasury bill, I'm actually measuring it against their own money supply and gold. You see, gold is the true yardstick for measuring the return of an investment. If it cannot outperform gold or the money supply, which are both the same almost, it's not worth an investment. And it certainly does not qualify for buy, borrow, die. Now, the first one on the screen you can see is Argentina. This is very good because it's obvious. It's very obvious, it's very blatant. What I've got here is two numbers, 75,000 and 150,000. The 75,000 is the stock market return over the last 20 years. So think about it in nominal terms. It would have outperformed every market on earth, every stock, 75,000. But all that really happened is they just printed money. So 150,000% was the increase in the money supply. And what you'll see is this pattern is the exact same for almost every global index apart from four that I found. And this is going to really expose the true reality of how difficult it is to create true, real wealth for a country to do this, for a company to do this. Because the power law is like a law of physics. The capital all goes to the true monopolies. They're not just good companies. These are the backbone, the bedrock of the global infrastructure. And look here, there's more. Turkey, Vietnam, and China. China's very interesting. Over 20 years in China, the actual nominal return was only 60%, and they increased their money supply by 750%. So the actual true return over 20 years was minus 690%. Very difficult for the Chinese to generate true wealth using the stock market or even property, because they build so many properties, they build empty cities, and it's very difficult. It's a big challenge for the Chinese to generate true wealth inside the sandbox. So that's why they want to take advantage of investing in other markets. And you see the same pattern here. Look at all these countries. These are all global indexes that you will recognise. Greece minus 40% over 20 years. That was even nominally, and they printed 145%. All these returns, the true returns, are completely negative. Completely negative. What you're seeing here is the market, the actual market for the country can really only grow there needs to be a public company in the country that generates so much demand from the rest of the world. And what I do find is a lot of these countries, some of them have great companies, but it might not be enough to generate true return. And this is vital to understand, because think of all the pensions of the citizens in the country. They're investing into their own stock markets, and they're actually destroying wealth every day. And this is why it's so important to not fall victim to a nominal return. You must measure the nominal return against the money supply and gold. Gold's a very simple, straightforward one. Yeah, but because it's so volatile, it's easier to use the money supply. But you don't need to do anything, because I'm going to show you in this video exactly which companies, which indexes create true wealth. So there you have it: France, UK, Australia, Thailand, Singapore, Spain, South Korea. Good nominal returns. On the C section here, this is their nominal growth over 20 years, and it looks impressive. But when you account for how much money was printed, it just props it up. Currency is not value. Currency can just be printed and created, and it doesn't. If it's a circular loop, a country just passes money around itself, it's really not going to have that true growth. Other countries need to get the demand. That's why you start to realise how important it is for tourism for countries. But tourism doesn't generate money into the public markets of that country. They need to sell something to other countries. Now, Netherlands interesting, 180%. Guess what that was driven by? That was a nominal return of 35%. Still not impressive, but that was primarily driven by ASML. So one company pretty much driven all that the market return. Switzerland, 100%. Japan, India, and of course USA. Here we have at the top. So what you see here is India, USA, of course, the S&P 500, Taiwan, of course. That's effectively TSMC. So a single company generating all the true return, because there's so much demand, it's soaking up all the billions of dollars into their economy. Denmark is primarily because of Novo Nordisk, and USA, the top of the funnel. True growth, the NASDAQ. I use the NASDAQ 100, and that's generating true real alpha. So of all the global markets, so very few actually created a true alpha. This is all the global stock markets of the entire world. This is all the public companies. And yet, 97% of them are not actually generating true wealth. See, you're told to diversify, but you're just diluting the same assets. Because when you have a global wealth fund, for example, all the actual growth is coming from TSMC, ASML, Novo Nordisk, and the Mag 7. And you've got all these other indexes which are complete dead weight. But it's to make it feel psychologically safe. It feels safe because it's less volatile. Now, we're not finished yet, because I'm going to run it through an even more aggressive filter. Keep in mind, the real alpha is in their own currency. How much actual growth is there if we actually convert their currency into gold? Gold is the benchmark. And immediately, we act as a guillotine and cut out India, Switzerland, New Zealand, Germany, Sweden, Netherlands, Japan. Their true return in line with gold is negative. Do you see how absolutely brutal this really is? This is such a reality check. So out of thousands of publicly traded companies across the globe, the entire engine of human economic progress over the last 2 decades was restricted to just 4 indexes. The NASDAQ, S&P 500, but again, the S&P 500 is the same as the NASDAQ, just with more dead weight. I've proven this many times. TSMC carried Taiwan, Novo Nordisk carried Denmark. Everything else on earth, every other bank, retail store, construction firm, telecom provider, was a net negative wealth destroyer when you measure it in gold. Yeah, so look, the true return measured in gold. Of course, the NASDAQ 100 has a real return. So does Taiwan, S&P, and Denmark. Keep in mind, the S&P, the S&P is only within the most of the actual returns is in the last 4 or 5 years because of AI. Before that, it would have not made the list. It's truly because of the AI build out right now, the industrial boom that's happening, that is actually creating it's creating true wealth now, but it's not the case before. So a lot of people might say, well, that means the S&P 500 is fine. It's still not, because you're still leaving money on the table. You're leaving money on the table. Again, you're carrying dead weight companies. A lot of the companies in the S&P are not even got a positive shareholder equity. It is the same companies that are creating the wealth, the true wealth generation. If you're wanting to understand this, the reason this is so important to understand is it applies to everything. It applies to every single business, every single investment. It is all the same. Measure it against gold. The same applies to real estate. Someone can see their property double, triple in price in nominal terms, but if it's not outperformed the benchmark, which is the money supply in gold, it's actually a net purchasing power change. Now, before, it might alarm some people that might be a business owner. However, the paradox is public equities, public companies are larger, and the larger they get, the smaller the return on invested capital actually becomes. Whereas small businesses, like a boutique business, can have a high return on invested capital. It's actually when the business grows that it loses its ROIC. So if you're a business owner, you must understand this. It's vitally important, because this will tell you whether you should be reinvesting in your business or investing into the financial markets. Because you're losing opportunity, and it depends entirely on the business model you have. And if you're someone who's on a salary, of course, you know exactly where your money should be going to generate true wealth, because a lot of the painful truth is many of these businesses would have had a better return holding a bar of gold than a lot of the people in these countries that their pensions are going into the local country stock market, and they're not even getting true wealth. And it's something that the majority of the world are completely blind to, because they're trapped in the nominal illusion. They understand Argentina because it's very obvious. The scale reveals the truth. Because people can see that the stock market went up so fast and the currency was printed to infinity, it's easy to understand, but it's difficult to see when it happens very slowly. But it's vitally important, because I said this before, we do not track CPI, Consumer Price Index, as the cost of survival, whereas the money supply is the cost of power, the cost of scarce assets. If you are constantly outperforming the money supply / gold, you're creating true, real wealth. And it applies to every investment. So there you have it. You have the entire global index. I went through every index I could see, and it's all generated by a tiny concentration. The concentration is not the risk. It really isn't the risk. And diversification isn't safety. You're just diluting yourself. Because what's going to happen is when you understand this and you make investment choices, whether that is individual companies that are the monopolies or it's more concentrated ETFs, a growth ETF. I always use the NASDAQ. I have my reasons, by the way, that I use the NASDAQ. There are other growth ETFs, the VGT, the semiconductor options. Yeah, look, that's outperformed violently. SPMO, a lot of people love that. And yeah, it's a momentum ETF, fantastic. What I love about this one is the actual, the defensive capabilities of this one. I will make a video on this because in 2022, it actually performed very well during a Fed rate hike. Your asset selection and your asset location is so vitally important, and it's so important to understand this, what you're measuring your wealth against. Once you internalize this, you escape the illusion, the nominal illusion. Currency can just be created. We don't chase the currency, we chase value. Currency is just printed. All these countries print the money, inflate their stock market, and it acts as a pacifier. The masses are pacified by the nominal illusion. They're all trapped, staring at the numbers on a screen. And the truth is, wealth is about the weight. The weight of the stocks that you have, the weight of gold, it's always been the same. It's not about a nominal number. Nominal numbers can be faked and inflated. So there you have it. It's even worse than what Bessinbinder, the study that he proved. And once you understand this, you're fully escaping. You're actually able to solve the problem. You're not going to fall for the trap that the masses fall for. Because it's actually more important to avoid bad investments, than it is to chase good investments. It's far more important because you can act as a filter. You can just cut through all the noise and chase true, real wealth. And you can, once you understand this first, then you can use the buy, borrow, die framework correctly and structure the portfolio where it's balanced. You can borrow against it without any fear of a margin call. You don't need to worry about repaying the loan. See, this is more scarcity mindset that the general masses have. But if they actually had their assets assigned correctly first, the last thing they'd be worried about is repaying a cheap loan, because money is just printed anyway and is diluted. It loses value as time goes on. This system will not change. This is the whole global economy operates under this same money printing strategy. So once you've internalized it, you can solve the problem.